Hey everyone, welcome back to the channel. So in this video, we're going to talk about Cumulus Media and their Q3 earnings results. And this quarter was a very good quarter following up on their very good second quarter. So what we're going to do is go through some of the highlights and talk about what their path is going forward to what I think will be a much higher share price. So here are the key highlights for the third quarter. First, they grew revenue sequentially each month. So every month in the quarter, the revenue got higher, and total September revenues up 35% over the June revenues, and that included both their spot revenue, which is the typical radio broadcasting, and their digital podcasting segment, which grew by 50% year over year, which is just insane. And we'll talk about that in detail later in this video. They got in the quarter political revenue of 5.8 million, and this is big. This election season is going to bring in a ton of cash for Cumulus, and we saw that in the third quarter, almost 6 million. And this doesn't even include all of the political revenues they got, because it only counts up to, because the third quarter only went to September. So the whole month of October and the beginning of November, they're still getting those political revenues, and typically fourth quarter political revenues in election years are higher than third quarter. So that's something to watch out for in the next quarter. Okay, generated positive cash from operations. Again, even though this company on an earnings basis is losing money, what I'm keeping an eye on is the cash flow from operations, which is usually what I do anyway. And they've been able to keep that positive every single quarter this year, which I think speaks to how much the management is focused on turning this company around, driven mainly by tight expense and working capital management. That includes 25 million of fixed cost expense reductions in Q3 year over year, and that total reductions for the year of 2020 will be more than 85 million, which is almost the company's entire market cap. So that's pretty crazy if you think about that. And the balance sheet is getting better by the quarter. They now have 350 million of cash. They completed the initial closing of their tower portfolio sale, and that will bring them another 200 million. So that hasn't even come to the company yet, but that's coming at the beginning of next year. And in addition, they've continued the trend of paying down their debt in advance, paid down 49 million of term loan at transaction closing and 47 million of senior secured bonds on November 3rd. And this is a huge deal, because while it is important that they're taking down the leverage of this company, they're also saving on their interest payments when they reduce this debt voluntarily. And so the interest on this debt was something like 5.5%. So if we do the math for that, 47.2 million, and you times that by 0.055, so 5.5%, that saves the company 2.5 million per year on interest payments. And so, that's a big deal for this company that has so much debt. The fact that they're able to pay it down in advance to save these interest payments every year is definitely helping out this company in the long term. Now we're going to take a look at the revenue detail, because I think this gives us a great picture into what kind of valuation this company should get once they're successfully deleveraged. And what we're going to look at specifically is the digital podcast network, because even though currently it makes up around 30% of the company's total revenues, if you value it like some of the other podcast businesses out there, because this is what I think gives you a real sense of how undervalued this company is. So if we take a look at just for the third quarter, the 3 months ended September 30th, these are in thousands. So the digital podcasting part of the business brought in, we'll call it $20 million of revenue. And so they grew 50% year over year. And I think this trend is here to stay with the growth in the podcasting segment. So if you annualize this, say they do this every quarter, that would mean they bring in 80 million per year of revenue from the podcasting business. Now, to see how that's valued in the stock market right now, we could take a look at a company like Spotify, which is mainly podcasts but also music. And if you want to value Spotify based on the revenues, right now their price to sales is a 5.37. We'll call it a 5. Spotify trades at around 5 times sales. Now, obviously, it's not going to be exactly the same. Spotify also has other things like music, but I'm pretty sure their main moneymaker is the podcast business. So if we consider that and say, the fair value for a podcasting business is around 5 times revenues, well, then we can come back to the calculator, and that would be 80 million per year times 5, and that gives you a valuation of $400 million. And keep in mind that this is just for the podcast part of Cumulus, not for the broadcast radio, which is the majority of the revenues. And right now, if we take a look at what the market cap of Cumulus Media, the entire company, is, it is at $115 million. So if you consider that for a second, if just the podcast part of Cumulus was valued like Spotify, the company would be worth $400 million, almost 4 times as much as it is right now. So that's one of the reasons why I'm so bullish on this company. They have an asset in the podcasting business that's being really covered up by all the other, apparent problems that the company has. I think the market is underestimating the potential once we see the debt continue to be paid down. Now we're going to take a look at the earnings call transcript because the management has some interesting things to say in here. So I'd say the first notable thing the CEO says is that they finished the quarter with $350 million in cash, and with the environment uncertain like it is right now, they have the resources and flexibility to respond to opportunities that might arrive from the disruption and invest in areas that will drive growth while continuing to improve balance sheet. And then later she says, given our liquidity position, more efficient expense profile and growth initiatives, we feel comfortable with our ability not only to stay the course, but to capitalize on the rebounding economy where and when it occurs. Now, here's another interesting thing going on with the company. Usually, they pay for their rights to broadcast the NCAA March Madness tournament, but as we all know, that did not happen this year. So there's actually a lawsuit going on with the company suing the NCAA because they think that they shouldn't have to pay those rights of the 2020 season since they didn't end up broadcasting it to the NCAA. And that probably makes sense. They'll probably come out the winners in this lawsuit, but it is something to keep an eye on. Even though either way it won't have a huge impact on the company, it would always be nice to have a monetary award come in from that. Now, not much in terms of the Q&A. The first one was asking about how, they talk about how they have a large cash position, but what are they actually planning on doing with that cash? Is it just to pay down debt, or are there also opportunities for growth in there? And I think the CEO gives a pretty good answer that they have this huge cash position and they are now in a fantastic position to be defensive and opportunistic in the ways that they can use that cash. So they say, obviously, paying down debt is a huge priority, as it should be, but they're also keeping their eye open to interesting opportunities in terms of acquisitions or other ways to invest that money to generate future returns. So I think that's a pretty good answer. Right now, I still think priority should be 100% towards paying down debts, but after a while, there's going to be a point where the company doesn't need to focus on paying down debt anymore, right? Cumulus doesn't have to have zero debt. It's okay for them to have some debt. I would say the debt that they have right now impacts their ability to operate as a business, but once they get that down to an acceptable level, they can start looking at other ways to use that cash that they have. And so I think it's good that the management is keeping an eye out for opportunities, but right now I still think the debt paydown should be the biggest priority. So that's it for the third quarter results of Cumulus. All in all, my long-term thesis for this company is still intact. Where you take a look, this is from 2019 by quarter. Every quarter this company has consistent operating cash flow and free cash flow, even though they haven't been profitable. These are the two numbers to look at: cash flows from operations and then the free cash flows. And even through one of the worst economies ever, this company is still able to consistently generate positive cash flows every quarter. And so it's because of that when I think if and when the economy recovers, these cash flows are just going to get bigger and more stable. And after the company turns the corner on their debt and it's down to a reasonable level, the market will see that and they will value the company much higher than they're doing it right now. Another thing to look at is their cash. Their cash balance has skyrocketed in the past few quarters, and this only goes up to the second quarter of this year, so it's even higher now. And again, on top of that, they have the extra $200 million coming in from the sale of their tower portfolio. So looking at how the stock did, they did have a pop on that earnings day. Right now sitting at under $6. And like I've said, this company, from any way you look at it, is incredibly undervalued in my opinion. By the end of 2022, if the economy is recovered, then this company should go back to the $15 to $18 they were at the end of 2019. And looking forward from there, I still see good opportunities for growth. So I am up a ton on my position. My average cost is around $3.50, which I showed in my full portfolio reveal video. So as of right now, I think the company has had a lot of good news over the past few quarters. I don't know if they're going to fall to under that $4 mark again. That's originally where I said I would buy more if the stock fell back under $4. Now, I don't know if it's going to get back down there unless there's a huge crash in the stock market. And so because of that, I would now probably consider buying this stock whenever it is under $5. I still think that's an incredibly good deal. Obviously not financial advice, and always do your own research before buying a stock. Don't just because you're watching this video. But I do see enormous upside potential for this company over the next couple of years. So that's it for this video. If you like the info, hit the like button to help out my channel. If this is your first time watching, subscribe to get more videos like this. So that's it for now, and I'll see you on the next one.